The majority of market analysis is focused on the critical question of timing, that is, attempting to determine when a significant market move is likely to occur. But Richard D. Wyckoff was equally concerned with the magnitude of the move, and he was able to combine these two dimensions of analysis because his entire approach was built upon the unchanging universal laws that govern price movement. His entire scientific method is predicated on the idea that the stock market, far from being a chaotic, unpredictable entity, is governed by principles as immutable as the laws of physics. We begin our masterclass with the most fundamental of all these principles, the first law of the market, the law of supply and demand. This law is the engine of all price movement, the sole determinant of a security's direction. It is a simple, logical, and universally applicable principle of economic life. The law states, if demand is greater than supply, the price will rise. If supply is greater than demand, the price will fall. If demand and supply are equal, the price will move sideways in a trading range, seeking equilibrium. This is the primary force. Every single price fluctuation, every rally, and every decline, whether on a chart of a major index or a single microcap stock, is merely the visual manifestation of this eternal struggle between buyers and sellers. For the classical economist, this law is a theoretical concept. For Richard Wyckoff, it was the foundation of a practical trading method. Wyckoff's genius was in transforming this abstract economic theory into a concrete, measurable, and highly actionable analytical tool. He asked a critical question. How can the speculator measure the relative strength of supply and demand in real time? The answer is the volume of transactions. Wyckoff taught that volume is the true measure of the intensity of the market's interest. It is the quantifiable evidence of the effort being applied by either the buyers or the sellers. Price alone is often misleading. It is the combination of price movement and its corresponding volume that reveals the truth about the underlying balance of forces. Let us examine the practical application of this law through the lens of Wyckoff's tape reading. First, when the market is rising, the price movement is sustained by the law that demand exceeds supply. The professional analyst observes this action by confirming that the rallies are consistently accompanied by relatively high expanding volume, while the reactions or pullbacks are met with low diminishing volume. The high volume on the advance is the proof that demand is intense and actively committing capital, while the low volume on the pullback is the proof that supply is weak or exhausted. Second, when the market is falling, the price movement is sustained by the law that supply exceeds demand. The professional analyst observes this by confirming that the declines are accompanied by high expanding volume, while the counter-trend rallies are met with low anemic volume. The high volume on the decline is the proof that supply is aggressive and dominating, while the low volume on the rally is the proof that demand is absent or passive. Third, when the market is in a trading range, the law states that supply and demand are in a state of relative equilibrium. This period of sideways action is not a time of rest. It is a time of immense hidden activity. It is the proving ground where the composite operator, the unified concept of large informed financial interests, is either accumulating shares to build a future long position or distributing shares to build a future short position. During this crucial preparatory phase, the supply and demand are roughly matched, resulting in price fluctuation within defined upper and lower bounds. Wyckoff used this foundational law to create the models of accumulation and distribution. These models are simply a pictorial representation of the struggle between supply and demand, as the composite operator uses time and price to achieve his objective. The accumulation schematic, for example, shows how the composite operator must patiently absorb the overwhelming supply from the public in a prolonged process. The law of supply and demand is the lens through which we interpret every event in this process. The selling climax is the moment when supply reaches its peak but is met by an even greater hidden wave of professional demand. The spring is the final, decisive test to ensure that the remaining latent supply is truly gone. Understanding this law is not merely useful, it is indispensable. It forces the speculator to ask the right question about any given price movement. Which force is currently stronger, and what is the volume telling me about the intensity of that force? When used correctly, volume acts as a magnifying glass, allowing the professional to see the evidence of the large, informed interests who are operating beneath the surface of the market's minor price fluctuations. This video will give you the foundational rules of the Wyckoff method. But to apply these rules with the conviction of a professional, you need to understand the judgment that forged them. That judgment is the very heart of Richard Wyckoff's masterwork, How I Trade and Invest in Stocks and Bonds. This book is not a dry technical manual. It is the record of a 33-year career on Wall Street. Inside, Wyckoff shares his own campaigns, detailing the logic behind his profitable trades in stocks like U.S. Steel and his long-term speculative investment in Magma Copper. He dissects the methods of other market titans, analyzing the principles of legendary operators like Jesse Livermore and his double-stop rule, the industrialist E. H. Harriman, and the aggressive pool operator James R. Keene. The best way to access this timeless wisdom is through the modern adapted edition by Max Davidson. Its annotations act as your personal guide, translating the historical context for today's markets, and it includes illustrations and photos of the very traders Wyckoff used as examples. If our videos teach you the what, this book teaches you the how and the why. It is a complete course in building a professional mind. The link is in the description. We have established that the first law, the law of supply and demand, dictates the direction of all price movement. It is the engine that drives the market. We now proceed to the second fundamental principle, a law that allows the professional speculator to ask and answer the critical question of magnitude. The law that measures how far the market is likely to move. This is the second law of the market, the law of cause and effect. This law states with immutable clarity that the effect will be in direct proportion to the cause. A significant, powerful, and sustained vertical price move, which is the effect, cannot and will not occur without the preceding preparation of a commensurate, substantial cause. This principle is the basis of all rational market forecasting and the foundation upon which Wyckoff built his methodology for setting price objectives. It transforms speculation from a game of mere chance into a study of probabilities and potential. The immediate application of this law requires the speculator to define what constitutes the cause and what constitutes the effect on a price chart Wyckoff established, that the cause is the long horizontal trading range that precedes every major price swing. This period of sideways consolidation is the strategic arena in which the composite operator, the unified concept of large, informed interests, conducts his preparatory campaign of either accumulation, building a long position, or distribution, unloading a long position. The effect is the subsequent vertical price movement, the markup phase that emerges from an accumulation base, or the markdown phase that emerges from a distribution top. The profound wisdom of this law lies in its implication. The professional speculator must not only judge the character of the trading range, is it accumulation or distribution, but must also judge its size. A small, narrow base that forms over only a few weeks is an insufficient cause. It indicates that only a limited amount of energy was expended by the composite operator, and therefore it can only be expected to produce a limited and modest price move. Conversely, a long, broad, and extensive trading range, one that persists for many months, is the clearest evidence of a great cause being built. It proves that the composite operator spent a vast amount of time, effort, and capital absorbing stock or distributing stock, and he can only realize a profit commensurate with that immense effort if the resulting price move is equally vast. To translate this abstract yet fundamental concept into a precise, usable number, Richard Wyckoff pioneered the application of the point and figure chart to this law. The genius of the point and figure chart is that it converts the duration and magnitude of the sideways cause into a tangible, countable unit. This charting method filters out the distracting element of time. The amount of time that passes within the trading range is irrelevant. What matters is the energy built up. The point and figure chart measures this energy by its horizontal width, the number of columns the trading range occupies. The horizontal width of the accumulation base, or the distribution top, becomes the quantifiable measure of the cause. By conducting a methodical horizontal count across this base, the analyst is essentially measuring the total capacity of the fuel tank that the composite operator has been filling. The steps are logical and deliberate. The number of columns in the base multiplied by the box size and multiplied by the reversal amount yields a specific dollar amount. This dollar amount is the projected price potential, the magnitude of the effect. This application of the law of cause and effect is the great mathematical tool that allows the professional speculator to ask and answer the crucial question of how far, before he ever commits his capital. It ensures that his campaigns are only launched when the potential reward is logically justified by the preceding preparatory effort. Wyckoff's genius was his ability to decode the market by studying the chart. But his deep judgment was also formed by observing the great operators of his time, understanding their triumphs, their failures, and their mindset. To truly master the markets, one must study the masters themselves. This is why we have created a new channel, Wall Street Memoirs. This channel is a library of market history and wisdom, dedicated to the most important events, thoughts, memories, and strategies of the world's most famous investors. You will find valuable information that will help you both preserve and compound your capital by learning directly from the titans of finance. If you want to understand the minds behind the greatest market campaigns and learn from their hard-won experience, we invite you to subscribe and explore. The link is in the description. The historical record of the market serves as the ultimate proof of the law of cause and effect. Every great market campaign of the past, every famous bull run, and every devastating crash can be traced back to a massive preceding campaign of accumulation or distribution. The legendary campaigns of the great operators, whether it was Jesse Livermore executing a major short position or a famous syndicate launching a major bull campaign, demonstrate the immutable nature of this law. The vertical move that captures the public's attention is merely the inevitable consequence of the long, tedious, and deliberate process that the composite operator spent months building in the trading range. The size of Livermore's profits in 1929 was directly proportional to the immense preceding distribution that had been built into the market structure over the preceding years. The power of a single, well-executed campaign is the direct result of the meticulous energy expended during the preparation phase. Therefore, the professional speculator uses the law of cause and effect to establish a logical, evidence-based target zone for his campaign. He does not rely on arbitrary guesses or emotional projections. He calculates a minimum and a maximum price objective based on the measured width of the cause. This projection serves a vital function in his overall strategy. It provides a powerful psychological anchor during the campaign. When the stock begins to advance, the speculator is far less likely to be frightened out of his position by a minor correction, because he has a clear, calculated reason to believe that the price is logically destined to travel to the calculated objective. This law turns the subjective art of speculation into a methodical, objective science. It is the framework that allows the professional to maintain patience and conviction in his positions. We have established the first two immutable forces that govern the market. The law of supply and demand dictates the direction of price movement, and the law of cause and effect provides the crucial mathematical tool for measuring the magnitude of the potential move. We now arrive at the third and final fundamental principle, a law that acts as the ultimate filter, the professional speculator's internal lie detector, that allows him to distinguish between genuine strength and sophisticated deception. This is the third law of the market, the law of effort versus result. This law is the critical link between the price action and the volume that underpins it. It states that changes in price, the result, must be proportional to the volume of transactions. The effort. In a healthy, sustained trend, the effort expended must yield a logical corresponding result. When the effort and the result are out of sync, a condition known as divergence, it is a powerful and almost infallible warning that the existing trend is about to change, or that the price action is being manipulated by the composite operator. The practical application of this law is what transforms an ordinary chart reader into a professional analyst. He uses this law to confirm the sincerity of every price move. Harmony, confirmation. When the effort and the result are in harmony, the trend is healthy. For example, if a stock rallies on high increasing volume, great effort, and this results in a wide price spread and a close near the high of the bar, great result, the law confirms that the move is sponsored by legitimate demand. The evidence supports the action. Divergence, warning. When the effort and the result diverge, it is a signal to stand aside. The most common and dangerous example is the case of climactic volume with no result. Imagine a stock that is in a mature uptrend. One day, the volume surges to a climactic, immense level, maximum effort. However, the price bar that corresponds to this volume is narrow, or it has a long upper tail, and it fails to close significantly higher than the previous day, poor result. What does this divergence prove? It is the most compelling evidence of hidden distribution. The immense buying pressure from the public, the effort, is being met by an equally immense hidden wall of supply from the composite operator. The two forces are locked in a struggle, and the narrow spread proves that the battle ended in a stalemate. Since an overwhelming effort was required merely to keep the price from falling, the professional concludes that the underlying demand is exhausted and a change in trend is imminent. This law is the ultimate tool for avoiding buying into a buying climax or selling into a selling climax, as it exposes the exhaustion and absorption that define those turning points. The final objective of our masterclass is to synthesize these three universal laws into a single, cohesive, and powerful professional methodology. The principles of Richard Wyckoff are, in essence, the systematic application of these three laws to the continuous unfolding process of market activity. The professional speculator, before every operation, must apply these laws in concert, moving from the general principle to the specific tactic. The law of supply and demand dictates the strategic direction of the movement. This law is our primary compass. By analyzing the net balance of transactions, accumulation versus distribution, it tells the speculator which way to trade. It confirms that the path of least resistance is either up or down. The law of cause and effect dictates the potential magnitude of the movement. This law is our ruler. By measuring the horizontal width of the trading range using the point and figure chart, it tells the speculator how far the price is likely to travel. It provides the essential framework for setting logical price objectives and determining if the reward justifies the risk. The law of effort versus result dictates the probability and sincerity of the movement. This law is our final arbiter. By comparing volume against spread, it tells the speculator when to act and, crucially, when not to act. It filters out false breakouts, manipulative spikes, and moments of exhaustion, ensuring that the speculator only commits capital when the evidence is in perfect harmony. The successful speculator is one who can integrate these three laws into a single, fluid process of thought. He sees a base of accumulation, cause, which, according to the point and figure count, promises a 20-point rise, effect. He waits until a powerful rally occurs on expanding volume. Demand greater than supply and effort equals result, and he acts with confidence because all three of the market's fundamental laws are aligned in his favor. This is the essence of scientific speculation. In our final conclusion, we have dissected the three fundamental and immutable laws that form the intellectual core of the Richard Wyckoff method. These laws, supply and demand, cause and effect, and effort versus result, are not abstract theories. They are the practical, measurable forces that govern every single price fluctuation in the market. By applying this methodology, you are transforming your approach from a hazardous game of chance into a disciplined, evidence-based science. You are learning to read the market not through indicators that obscure the action, but through the universal language of price and volume that reveals the motives of the great operators. Your success will be determined by your ability to follow this logical framework. Use the law of supply and demand to find the trend. Use the law of cause and effect to measure its potential. And use the law of effort versus result to confirm the sincerity of its breakout. The consistent application of these three laws provides the only reliable path to achieving lasting professional results in the market.